Hi, I am Anna. I come from www.ntvforex.com. Asia Market Vaccine Hope continues to give the market a shot in the arm. http ntvforex.com News ID 6CEAA4 7/23/2023 33:13 am. U.S. equities were stronger Wednesday, with the S&P up 0.6%. Pfizer shares rose 5.1% after the U.S. government announced it has agreed to pay almost $2 billion for 100 million doses of a vaccine under development by Pfizer and BioNTech once the drug is cleared by regulators. The thought of having a COVID-19 cure in the hands of all continues to vaccinate the market to a degree. After all, a visit to your local doctor for a vaccine shot is the ultimate one-stop recession corker that eliminates the fear of the virus and will see consumer demand flourish. Rising diplomatic tensions weighed elsewhere, with the STOXX 600 down 0.9%, FTSE down 1% and Nikkei down 0.6% after the US asked China to close its consulate in Houston. In the main, the escalation in US-China tensions is a reminder of the headline risk faced by investors during the upcoming US election campaign. However, risk only retraced slightly. The enduring buy-in across risk markets this week probably meant that it was only new weaker positions that got washed out, as the main narrative around the notion that liquidity will support until the vaccine is in hand seems set for now. The US and China have become increasingly combative in their views this year, and the markets better get used to it because there's more of that to come even without Trump in the White House. A Biden presidency is unlikely to change travel direction in a tempering of China-US relations. So long as the deteriorating political scrim doesn't drive economic fragmentation between the world's largest economies, the political brouhaha remains a tempest in a teapot. The previous risk asset wipeout on CNH, Asia FX, oil, and U.S. equities in the past 2 years has been driven by surprise tariff escalation from the U.S. Trump felt comfortable to turn the screws on China because he perceived the U.S. had the upper hand. The stock market was flourishing and the economy was flying, so the U.S. administration's moves were from a position of U.S. economic strength. But with COVID-19 ravaging the Sun Belt, President Trump was unlikely to ramp up the trade war in the middle of a recession. Now that EU leaders have agreed on the recovery fund, the market is back to looking for something else to turn its focus towards. They don't have to look too far, with the Fed expected to keep the pedal to the metal, which should ultimately support risk assets as the Fed is in dove mode until well past the singularity. The impact of virus headlines is receding for stock markets, while price action suggests little care is being given to the rising US-China tensions. Left to its own devices and the wall of money argument, the path of least resistance across equities is an ongoing grind higher. Forex. Some pretty upbeat commentary on the EU's coronavirus recovery fund, written by rating agency Standard & Poor's, came out earlier. Its release, around 11:00 London, coincided with a rally in Eurist. We believe the political consensus in establishing the fund, and endowing it with debt-raising capacity, is a major step forward for the euro area in particular and will support Europe's long-term economic and financial stability. In that respect, the EU Recovery Fund is positive for European sovereign credit quality and all member states' institutional effectiveness, especially those in the euro area, S&P said. The euro is a more attractive reserve currency than it was just a few months ago, and the US COVID-19 story refuses to improve, suggesting growth divergence could come into play. Narrowing BTP spreads and some news commentary indicating the eurozone breakup risk could be a thing of the past is flat-out bullish for the euro. Precious metals are ripping and the Fed will be on hold until well past its average shelf life while engaging in unprecedented deficit financing and debt monetization. Stocks only go up in this environment, so it's hard not to be excited about short dollar trade. It takes two to tango CNH, but, of course, traders are looking for cracks in the narrative. Always fade moves when the commentary gets too one-sided. To complete the dollar lower thesis, USD needs to play ball, but it isn't. It's much easier for the USD to fall when USD Asia is joining the selling frenzy. CNH has been notably absent from the USD sell-off of late, and given the shifting tide on the currency narrative, I would have expected USD to be dipping below 6.95. CNH traders are worried the China hawks have the president's ear, or might even be in charge. Indeed, it's a factor that will weigh on currency sentiment in the run-up to the US election. There are several things to point toward a weaker US dollar. Deficits, interest rate differentials, and Federal Reserve actions are often cited. Granted, they have all seemingly mattered over time, but it's not entirely apparent what will matter and when it will matter. For me, it's all about growth. Trade and economic uncertainty surrounding China and relative growth rates with Europe are the two things to watch in the coming months. A European deal is a significant but not the only condition for the euro to hit 1.20. For the euro to trade higher in the coming months, it's all about divergence and whether European growth outperforms the US. If a vaccine gets delivered, never underestimate the US consumer's power. The ringgit, the Malaysia ringgit, has been trading upbeat this week primarily due to the broadly weaker US dollar, but is also receiving a lift by stabilizing oil prices that are trading towards the upper end of the current range. However, with USD trading back above 7.01, currency markets may hold off selling the dollar and be more inclined to book profit on further dips. Gold. Gold surges on geopolitical risk and fiscal stimulus prospects, nearing a record high of $1,920 ounce, but the rally could be overextended as Swiss gold exports in June to India and China near zero shows the scarcity of physical demand. The determining factor for the latest buying frenzy appears to be a turn for the worse in US-Sino relations. Not that gold needed a second wind, mind you, gold always seems to do well with US-China tension take center stage. Gold continues to float higher after the run of troubling headlines surrounding global COVID-19 case counts nearing 15 million. While this news brings a tear to one's eye, it helps gold as gnarly rises in case counts suggest more stimulus will be on the way. Indeed, if misery loves company, it's sure finding a friend in gold. Gold is shedding some weight in early trade after an impressive run over the past 48 hours. It shouldn't come as too much of a surprise that gold investors are coming up for air while the market consolidated ahead of the next key technical inflection point 1875. Subscribe our channel to receive the news as soon as possible. Thank you for watching.